most of the conference focused on human rights. So it's not a Bitcoin thing. It's mainly a human rights thing. But they're increasingly recognizing Bitcoin as a tool that can be used just like any other tool. And Bitcoin can be used to, receive and transmit value in a hostile financial environment. The World Economic Forum that was going on, that's where a lot of the altcoiners are going. The Bitcoin and stablecoin people were kind of at the Oslo Forum. And, basically it's like, one is like real world tools and things like that. And one's more about kind of Wall Street like, right? So it's utility versus more investing and speculation. So I think that's the most important angle of the whole thing. That's kind of going back to the roots of why Satoshi made this whole thing.
Mm-hmm.
He didn't talk about, hey guys, we're all going to get rich. He's like, here's like this private peer-to-peer type of money, right? And so this goes back to those roots. Yeah, at the end of the day, what we're watching is this network monetizing over time. And if you look at the chain analysis crypto adoption index, it's Bitcoin, but it's all, it's stable coins, it's all of crypto. 19 out of their top 20 countries are developing countries. And the one outlier is the United States because we're weird. But, so it's basically, it's not surprising that places where you either have arbitrary bank freezes or persistent inflation problems, they're more likely to use these alternative monies and these peer-to-peer cryptographic monies. It's one of those things. Some of them use Bitcoin, some of them use stable coins. But then there's also a lot of scams in the whole space too. So it's why, education is still important. But basically it's, this goes back to the roots of why this technology was invented in the first place. One of the big markets is just crypto trading, right? So that's where a lot of the Ethereum ones are used. The ones that go on Tron are optimizing for lower fees. And they're the ones that a lot of people in developing countries are actually using as dollars. They're using them for savings, things like that. Now, as you point out, there's a lot of problems with the underlying foundation that they're on. But the whole point of a stable coin is so Bitcoin's the most decentralized. It's the one that's globally decentralized. Whereas what a stable coin's basically doing is saying, okay, so it's centralized, but the central hub is outside of the country that is confiscating your dollars and is having a currency crisis. And so if you're, say, Nigerian, and you hold tethers or something like that, they perceive that as safer than if they try to store dollars in the local bank. There's a precedent of countries like Lebanon and Argentina. When they have currency crises, they say, oh, you have dollars in the bank, we're going to go ahead and convert them to local currency at the exchange rate we pick. And so any attempts to protect yourself from that inflation just fails. And so they'd rather have this kind of peer-to-peer version with the central hub outside of the country. Now, of course, they have to rely on that hub. They have to rely on that protocol. And so it's not an ideal long-term solution, but it's obviously an important bridging tool for the environment that we're in right now, because a lot of people, they just, if you make $400 a month and you have $400 expenses a month, you can't risk volatility for that, right? And especially if you're trying to save for a 3-month, 6-month, 12-month period, being 100% in Bitcoin is challenging. And that's where stable coins can be useful for them. And so it's serving a purpose. And then there's all sorts of technologies like Taro and things like that that could eventually bring them back to Bitcoin and Lightning. I mean, they originated on Bitcoin. Mm-hmm. They moved out to where, just market activity made it cheaper. Maybe they'll come back. So we'll see what happens over time. Well, so essentially we're having an inflationary crisis, and it's hitting developed markets for the first time in decades. I mean, developing countries go through this regularly, at least many of them do. And now it's hitting developed countries across the board, some harder than others, especially Europe, less so Japan, but really across the board. And that's mainly because commodities are a global market, and that's a big driver of what's causing this, as well as supply chains. And, whereas last year we were in this pure inflationary phase, now we're kind of in the central bank counterattack phase, where, they kept saying it was transitory. They kept saying, don't worry about it. This will be, there's base effects and things like that. And some of the base effects were real, but they were sugarcoating the type of inflation that we were actually getting and probably about to get. And because they weren't acknowledging how much new currency supply was created in a short period of time compared to real world constraints around commodities and logistics and things like that. And so now we've added a Russian war to the mix, right? So that further makes it challenging to, optimize commodities where they need to be. And then we also have very draconian Chinese lockdowns, very large percentage of the population. And that's the manufacturing hub of the world and the shipping hub of the world. And so that kind of gums up the supply chain problems. And so we both have limitations on the real world side, while also having a lot of currency having been created. And so now we're seeing the inflation roll through the system. And it's particularly getting bad in Europe, but it's bad, throughout the world at this point. And so now central banks have their credibility threatened, where they said it was transitory. It's far higher and less transitory than they kind of sold the idea would be. And so now they're in the phase where they're trying to tighten policy, but the whole point is that unlike say the 70s, there's so much debt in the system that trying to tighten policy is kind of this temporary thing where they want to act like they can stabilize this whole thing. We can get back to positive real rates. We can totally normalize this. But the problem is that the only way for the central bank to push back on inflation is to reduce demand. They can't print oil, they can't print copper, they can't print chips. So they say, okay, there's a supply side constraint. We have high inflation. If we reduce demand, we can take the edge off prices. But what is a reduction in demand? It's a recession, right? And so right now, inflation is very politically unpopular, but you can bet that if you were to reduce demand and increase unemployment, you'd have different types of things that are unpopular, right? That would also be unpopular. And I think that at the very core of it, there's two main problems. One is we've underinvested in energy in multiple ways for several years. And so there's just not enough energy and it doesn't get easily to where it needs to go. So that's number one. And that's very different than the past decade where we spent a large portion of the time with an energy oversupply. And we also had a slowdown in emerging markets. So demand was less than anticipated and supply was more than anticipated. So we had this glut of oil for a period of time. And that really destabilized prices, brought them low. That was good for some industries, obviously bad for the producers. But now, due to the combination of nobody wanting to invest in that because the prices were so low and because of ESG concerns and things like that, there's been underinvestment, and we've kind of drawn forward a lot of the benefits we got from shale, right? So that rapid increase in shale can't just keep continuing the way it was, right? There's only so much shale oil that's available. It has very fast decline rates, it requires constant capital injection. So now we're in this phase where we don't really have enough energy, and it also doesn't get to where it needs to be, and so that's just a constraint, and that takes time to work through. The market forces have to work through that and find new energy to bring the market, different types of energy. And of course, the other one is the whole supply chain. So for the past 10, 20, 25, 30 years, we've had this period of persistent globalization where, we're finding these big pockets of labor throughout the world that were previously relatively unused in the global market sense, and optimizing that, or geographic arbitrage, where you say, okay, so instead of having this expensive factory in Detroit, we'll go ahead and move it to China, right? And so you arbitrage that labor cost difference, and we've had that pressure for really for 25 years now, especially the Chinese part of it. And in some ways it's been longer than that, but really that past 25 year period's been very aggressive in terms of how much globalization's happened, and that's been a very disinflationary force.